Hey Art, how you doing?
Doing all right, Jeff. How are you?
I'm great. I'm excited to talk about today's topic because I just saw something that said one of three Californians are on Medicaid, which means today's topic is so relevant to so many people just in the state of California. I can't wait to get into it. But I understand there's some concerns about this particular type of loan. Can you share with me what you're thinking of, like, hey, people, when you say reverse mortgage, they're like, can you tell me your thoughts on that?
Yeah. It's interesting for all the years I've been in the business. Now, I'll tell you, reverse mortgages way back several decades ago, they were imperfect, maybe not as good, certainly not as good as they are now. But I've often said that reverse mortgages, even today, are probably the most feared and most misunderstood mortgage product in the industry. And it doesn't need to be that way. So my hope and goal is here to try to clarify some of these misconceptions and help people realize, as I'll say Tom Selleck always says on his commercials, it's a loan like any other. It does work a little bit differently, but it's a loan, just like your existing first mortgage. That's all a reverse mortgage is. It just behaves differently. And frankly, it behaves in a way that's supposed to help senior homeowners who are facing maybe some financial distress or maybe need some supplements to their income. That's really what it's all about. So that's what we're going to try to help people understand today. And I have some personal experience with this. I'll tell you real quick. My dad back in 2006, he was a homeowner, owns a home in Fontana, had a modest mortgage on it, about $125,000, costing him almost $1,000 a month. He had a little bit of an investment account that he had when he inherited from his parents. And I found out he was dipping into that for living expenses because he was on very limited income. He only had Social Security and a very small pension. But then I also found out that he was paying extra on his mortgage. And I thought, well, that's odd. On the one hand, you're complaining about having to pull some of your investment account to live on, and yet you're paying extra on the mortgage. I challenged him, why are you doing that? And he says, well, I'm trying to pay down the mortgage so I can create more equity so that when I get old, there'll be more equities for you and your brother and sister to, tap into to help take care of me. And I said, well, understand your focus there, but there's a better way to do it. So I presented him with the reverse mortgage. Again, this is back in 2006. He was 80 years old. And, he's a smart guy, mechanical engineer. Initially, he was skeptical. So I took some time. You have to go slow and be methodical and address every concern. Finally did that. We went ahead and arranged the loan for him. It did a couple of important things. It paid off his existing mortgage, so he eliminated $1,000 a month in mortgage payment. And then in addition, which we'll touch on in a minute, he chose to get the balance of that reverse mortgage that was available to him and set up a monthly check that he receives for his lifetime, which was also almost $1,000. So by closing that loan, and of course we did it in 2006 at the peak of the market when his home value had gone up quite a bit, he was able to have a $2,000 swing in his monthly cash flow, which allowed him to be able to continue owning the home and be much more comfortable in terms of his living expenses. He didn't have to tap into his investment account. It worked out very well. And he continued to get that check for 14 years. I mean, he made it till 1994 before he passed away. I'm not sorry. He made it to 94 in 2020 when he passed away. So for 14 years, he got that check. And it was a great help to him. So I have personal experience with that. So.
Well, with that story, which is amazing, that this is an instrument that you have full knowledge of, that your father was really acting like, and forgive me, I don't mean this disrespectfully, he was acting like the I would say the average person out there when they hear reverse mortgages, like that's probably a bad idea because
Right.
I'm going to lose my home, or I'm going to live on the street and things like that. But that's just simply not true, is it? When that happens.
It's not true. And yeah, he had the same preconceived notions that a lot of senior homeowners have. And I was able to successfully address all those concerns to the point where he was comfortable going forward. And, not long after we did it and he started getting those checks, he had that mortgage payment paid off. He came back to me and said, you know what, I was wrong. And he was very thankful for my advice and help to get his financial situation improved. So that he could live comfortably and enjoy his, the balance of his years. So it was really a good outcome.
I think that's great. Well, I want to let everybody know that this is a live program, and I'm watching the comment section. If there's something that comes up during today's conversation, you're saying, "Hey, I'd like to know more about that because we were talking about it, we didn't address it." Please put that in the comments. I want to make sure before you leave today, before we go off air today, that your questions are answered. So, Art, I have a list of 5 questions, and they're from the most ask questions to the least, but there's only 5. I mean, there's a lot of questions when it comes around reverse mortgages, but this is the top 5. Are you ready?
Sure, I'm ready.
Okay, so the first question is, hey, what happens to my home if I pass away or need to move into a nursing home? Because quite frankly, isn't that a great way to handle that process?
Yeah, a couple things. When a homeowner gets a reverse mortgage, of course, they're required to live in the home. That's a key requirement of the program. When they pass away, or the other common scenario, if they have to vacate the home, typically, nursing home or assisted living, what have you. And if they end up having to vacate the home for, more than 12 months, well, technically that does trigger a default on the reverse mortgage. Now, default is a scary word, but I want to tell everybody, reassure everyone, it's not as scary as you think. And again, I experienced this myself when my dad passed away. I was the trustee of a living trust, so I had to handle what to do with this reverse mortgage, because in his case, the balance in that loan got to be over $400,000 after starting at $250,000 in 2006. By 2020, it was over $400,000, and I had some concern if the home value was enough to even cover that loan balance, which again we'll cover in a minute. But so what happens is, when the homeowner passes away or they vacate the home for more than 12 months, that triggers a default on the mortgage, which means the reverse mortgage has to be paid off. Mm-hmm. But what the heirs need to realize is you have multiple options to accomplish that. One option is you can keep the home. The family, the heirs can keep the home. Yeah, they do have to pay off that reverse mortgage because they're not the original borrower. They're probably not over 62 and so forth. So then it's a function of how are they going to do that? Well, in some cases, the heirs, but maybe one of the heirs or a multitude of the heirs, they may have enough funds that they can just pay off the mortgage and keep the home, either for another family member to occupy or maybe to keep it as a rental. So that's, of course, one option. Another option is the heirs family can keep the home and simply refinance it into a traditional first mortgage, conventional loan, whatever, and keep the loan that way. Another option, and this comes in more often when in the rare case where the balance on that reverse mortgage is higher than the market value, the family will look at that and realize, well, it doesn't make sense for us to try to pay that off with either other funds that we have or do a refi, because probably can't do a refi, but the home's worth less than the loan balance. So then what do? You can actually deed the property back to the lender. It's called deed in lieu.
So wait a second. So what you're saying is if that property, because of the reverse mortgage, is now worth less than the debt or the balance owed, they can just walk away?
They can basically, like, as they say, mail the keys back. Or it's technically called a deed in lieu of foreclosure. They can simply deed the property back to the lender. And again, I know this because after my dad passed, I got a letter in the mail that spelled out these options from the lender. The other thing is you can let it go to foreclosure. The owner of the property, of course, has passed away. It's not going to affect the credit of the remaining, family members or heirs. So another option is let it go to foreclosure if the balance is above the market value of the home. So those really are some of the ways that you can deal with it as the heirs or the family. Now, the other option, obviously, which is what I was contemplating when my dad passed away, is just sell the home. Initially, I wasn't going to do that because it looked like the balance on that home of his was higher than the market value. But again, this was in 2020, in August, when he passed. And by the way, he didn't pass from COVID. He was 94 years old. He had other issues. But when I started to look at what was going on in the market, if you recall, market values at that point were starting to really go up quickly. Mm-hmm. And upon closer inspection, I realized, wait a minute, there is some equity here. So what we ended up doing is I went ahead and listed the property for sale. Now you have to communicate that to the lender. You got to let them know what your intent is, what you're doing. So I had to write a letter and let them know that, hey, we've decided we're going to sell this home, but we're going to need some time to get that done. For one, a lot of people don't realize when you have a trust, a living trust, you have to do what's called a 120-day notice to potential heirs or potential beneficiaries. So I explained to the lender, hey, we've got to go through this step first, and then we're going to list the property for sale and get it sold. As long as you communicate that, the lender will give you some time to get that done. Now, the other common question in that regard is, as we just touched on earlier, what if the loan balance is higher than the market value and the family decides they're going to still sell the home but do it on a short sale? That is a viable option, and it's important because why? The heirs, the family who inherit the home, they are not going to be personally liable for the deficiency balance if they sell the home on a short sale and sell it for a price less than the mortgage balance on the reverse mortgage. So a lot of families are worried that that's going to happen to them, but they're not liable. It's called a non-recourse loan. And the reason is the heirs are not going to be personally responsible if they sell the home and have to do it on a short sale and the proceeds are less than the reverse mortgage balance. That's okay. The lender will take those net proceeds. You can walk away, they walk away, and you're fine. You're not going to have any, liability for that deficiency balance.
I think that's very, very important, because I think some of the folks that probably you talked to maybe on the show today are thinking, if my adult parent does this and this kind of thing happens, they pass away and the home is not worth what the balance is, they're going to be stuck with it. And quite frankly, both sides are thinking that they don't want to burden their children with it, nor do the children want to be burdened with it. But you're saying that debt doesn't pass through.
No, it does not. It does not.
That's fantastic.
Again, common misconception. Yeah.
Yeah. Well, I just want to thank those people who joined us today. And again, remind you that if you have some questions about reverse mortgages, please put them in the comments and we'll get to them. The other question was, and I think you really kind of covered this, is how will a reverse mortgage affect my heirs and their inheritance?
Well, one other thing about that, that's a sensitive issue. And the reason is because sometimes the priorities, if you will, between that senior homeowner when they're contemplating getting a reverse mortgage and their family members, oftentimes their children in most cases, sometimes those priorities are not in alignment. And what I mean by that is we have to figure out whose needs are most important and should come first. In most cases, when a senior homeowner is going to get a reverse mortgage, it's usually because there's some compelling financial reasons why they should look at it. They may be on very limited income. They may be finding, as my dad found, that his limited income was not sufficient to maintain, even a basic lifestyle. He had negative cash flow, and he was troubled about running out of money from his investment account. So in a lot of other cases, that senior homeowner may have limited income to the point where they're having trouble maintaining what we call property-related expenses, property taxes, homeowners insurance, HOA dues if applicable, and most importantly, maintenance and repairs. So if the senior homeowner is in that situation, in my opinion, that's a priority. And even the family should support that. They should get behind that senior homeowner and help him or her pursue this option to help alleviate those financial pressures and burdens and help them maintain a better lifestyle for the remaining years. Now, in other cases, unfortunately, we'll see that sometimes the family members are not in alignment with those goals because they're looking at that home. Oftentimes it's a free and clear home, in fact, most of the time, or it has a very small mortgage balance. So they're seeing all that equity there, and they're concerned about, even though they want to help their parents, let's say, they are concerned that they're going to lose that opportunity for inheritance of a significant asset later. And so sometimes they're not in alignment with their, in most cases, parent in terms of what the priority should be. And that can be difficult. And that's why a lot of cases when, certainly when I meet with a senior homeowner who's considering this product, it's a very good idea to get the family involved, find out who within the family is going to be acting as their advisor. So I try to pull them into these discussions, show them the disclosures, try to have a discussion with all parties in the family to make sure everybody's on the same page as to whose priorities come first and should be focused on. And again, I would argue in most cases it should be the homeowner, and then the family members should just get behind that and not be an obstacle just because they're looking at, what they're going to receive in later years. They've got to look at the homeowner as the first priority. So
Absolutely.
I
Hey,
think,
I'm sorry, go ahead.
no, I just think that's the best approach.
We're talking about reverse mortgages today, and we've got Art Alvarez with MortgageWorks on the hot seat today, answering these questions. And I just want to make sure before we go any further is, can you explain exactly what a reverse mortgage is and who qualifies, and how hard is it to qualify to get a reverse mortgage?
Yeah, very good question. First of all, reverse mortgage, like I said earlier, it's a mortgage like any other. The key, it's once it's done, it's recorded as a mortgage, in California as a trust deed. It's a mortgage, just like your existing first mortgage. The difference is you're not required to make payments. Now that doesn't mean that you can't. Some homeowners will say, well, I don't like the idea of, great, I don't have to make payments, but isn't my loan balance going to go up? Yes, it will. Why? Because the interest that is charged on the loan, it's like any other mortgage, in this case, it gets added back to the balance. So over time, the mortgage balance is going to grow. So what's ironic about that, if you think about it, a reverse mortgage actually is probably the very first negatively amortizing loan product that the mortgage industry created. Well, of course, we all know the negatively amortizing ARM loans of the early to mid 2000s, the old option ARMs, were pointed to as a big culprit that led to the 2008, great mortgage depression and real estate depression. So isn't it ironic that a federally insured program designed to help senior homeowners is actually a negatively amortizing loan? But it is, but only if you allow it to be, and if you want it to be. If you're concerned about that, and maybe if you have the financial wherewithal as a senior homeowner to make payments toward that reverse mortgage, you're free to do so. And in rare cases, they will. Why? Because then they're going back to being concerned about their heirs, and they want to try to keep that mortgage balance from growing too much because they want to try to preserve that equity for their heirs. But that's pretty rare in most cases when we're arranging one of these loans. That senior homeowner really doesn't have the financial wherewithal to make those payments to avoid the negative amortization, and as a result, the mortgage balance is going to go up. Although in the disclosures, what we point out, the standard disclosure for HECM reverse mortgage, by the way, home equity conversion mortgage, which is administered by FHA, the standard disclosure will present numbers of growth in equity, even if you have one of these, based on a 4% per year home appreciation rate, which is actually a relatively modest target that's used. And in that scenario, if it sustains itself, home equity should maintain itself even after you get one of these loans.
And how hard is it for someone to qualify? Now they have to be a certain age, do they not, before they can get it?
Yeah, the minimum age for eligibility is 62. Now, one caveat to that. What that really means is at least one of the borrowers has to be 62. We run into cases quite often now where you've got a married couple, you've got one borrower 62, but their spouse might be 55. In the old days, not too many years ago, what had to happen was, to be eligible and get that loan, the couple would deed off the spouse who was under 62. Because having a borrower under 62 was not allowed at all. Well, in the law of unintended consequences, that turned out to be a problem. Why? When the older borrower who was eligible got the loan and then passed away, that remaining occupant, the younger spouse, basically was faced with a defaulted mortgage that they had to deal with and get it paid off. And in most cases, it caused them to have to sell the home and move because they were not eligible to take over that reverse mortgage because they were not 62. That's changed now. The program was tweaked to realize that that's not what we want to have happen. So now you can have at least one borrower 62, a spouse can be under 62, but then understand that the maximum loan amount you can get is going to be based on that younger borrower's age, not the one who's over 62. So that's going to diminish the maximum loan amount that you can get.
That makes sense. And how hard is it for someone to qualify for this? Because we are talking about a generation that's 62 years and older, and probably now they are not working. Their income is less. Is it difficult to qualify for a reverse mortgage?
Not too much. In fact, not at all like a traditional first mortgage. For example, there's no minimum credit score. There's no specific debt to income ratio that's calculated, a ratio of monthly payment and other obligations to your monthly income. None of that. Now, there is what's called a financial assessment that's done. And again, this has only been in place for the last, several years. 10, 20, 30 years ago, this wasn't the case. Now there is a financial assessment that is done. It's somewhat similar to underwriting a file for income and assets, but the idea isn't to focus on your credit score, isn't to focus on a debt ratio. It's to focus on between your monthly income that you do have and your other liquid assets. Do you have what, at least on paper, does it appear that you're going to have enough financial wherewithal to accomplish two primary things, or basically one particular primary thing: property related expenses, property taxes, insurance, HOA dues, like we talked about earlier, and maintenance and repairs. In that financial assessment, if it's determined the borrower isn't going to have sufficient income and assets for those property related expenses, then what happens is, from the loan proceeds, the reverse mortgage proceeds, there will be a LISA set up. Now, LISA is not a woman. LISA stands for, it's an acronym, Life Expectancy Set Aside. It kind of works like an impound account. So what the lender does is, based on the conclusion of the financial assessment, they may have to set up a LISA account where some of the proceeds are pulled from the reverse mortgage balance, set aside by the lender, and then that is used to maintain the property taxes, the homeowner's insurance, the HOA dues, and even access for maintenance and repairs. So that is the extent to which you have to be financially qualified to get the loan, is to just make sure you have the financial wherewithal to maintain those expenses. If not, it's easily solved by pulling that LISA account, the LISA funds from the loan, set them aside, and then hopefully, in the scenario that you have, the remaining portion is enough to meet your other needs.
Makes sense. The next question is, what costs or fees are associated with getting a reverse mortgage, and how are they paid?
Yeah, a really good question, and one of the major issues regarding reverse mortgages and people wanting to consider one. The biggest issue in terms of closing costs is mortgage insurance. And mortgage insurance anyway in the industry has always had somewhat of a bad name, in my opinion. In this case, mortgage insurance is deemed to be very expensive. There's two components of mortgage insurance on a reverse mortgage. And again, we're talking about the key product, the HECM, Home Equity Conversion Mortgage, administered by HUD and FHA. The upfront mortgage insurance premium on a HECM is 2%. And it's 2% of your home value or the maximum loan amount, whichever is lower of the two. And currently the maximum or what we call maximum spending limit is $1,089,300. So it's either 2% of that number or 2% of your home value, whichever is less. I recently did one where the home value was $675,000. So the 2% upfront mortgage insurance premium was $13,500. It's like, wow, that's a big number. Then in addition to that, there's an annual FHA mortgage insurance of 0.5% of the loan amount. Similar to a FHA first mortgage, where there's a 1.75% upfront premium that's financed into the loan, and then an annual 0.55% premium paid as part of your mortgage payment. So in the case of a reverse mortgage, similar, 2% upfront, then 0.5 annually. Now, you don't pay that out of pocket. Again, that mortgage insurance, that upfront premium, it's deducted from the reverse mortgage proceeds. So yes, it creates basically an initial balance on the loan because of that mortgage insurance being pulled from it. Then in terms of other closing costs, a couple of things. One is a lot of originators who do what I do, what you want to watch out for is a loan origination fee can be charged up to $6,000. Okay. We don't do that. When all the reverse mortgages that I arrange, we waive that. We don't charge the borrower $6,000 to get a reverse mortgage from us. Part of the reason for that, or the main part of the reason for that, is we also get paid by the lender based on the loan amount that's being obtained and how much they use initially. We are paid by the lender, and what we get paid by the lender is sufficient for us to meet our cost needs and so forth. We don't need to charge that $6,000. So anybody considering a reverse mortgage or talking to a lender about it, pay close attention to that, because that $6,000, you can negotiate that and you can get it waived. Or you can come to us and don't have to negotiate it. We just don't charge it to start with. And it does vary depending on whether you're getting an adjustable rate reverse mortgage or a fixed rate. A fixed rate reverse mortgage, there is going to be a loan origination fee ranging from $3,000 to $6,000. That goes to the lender. You can't avoid it. But most adjustable rate, most HECMs are adjustable rate because you can get more loan amount out of the program. And in that case, just pay attention to that $6,000 origination fee. Try to negotiate it away. And then other than that, the closing costs are like any other loan: credit report, appraisal, and escrow and title fees, which are pretty modest in most cases. $3,000, $4,000, maybe $5,000. It all depends on your loan amount. And again, all of those costs can be deducted from the loan amount. There's nothing out of pocket. About the only thing you pay out of pocket, at least with dealing with us, is you do have to get a homeowner counseling done, which costs $150 to $200. You have to pay that up front. And then the appraisal fee. And of course, we've talked on this show before, MortgageWorks, we don't charge that up front. We pay for it and then we get it back at closing. So other than that, there's no out-of-pocket cost, all financed out of the loan amount.
So it's very inexpensive. First of all, it's easier to qualify and it's very inexpensive to originate.
Right.
That's fantastic.
Exactly.
Well, the last question is, how will a reverse mortgage impact my eligibility for Social Security, Medicare, or other government benefits? I think this is a biggie, Art.
It is a biggie, and in a lot of cases, it's not as much of a biggie as you would think, although you're right about the 1/3 of Californians are on Medicaid. Here's how it works. It's all about those benefits and whether or not they are means tested or needs based. Okay. Social Security, Medicare, they are not means tested. They're not needs based. So getting a reverse mortgage, and by the way, let me, I should have said this up front. Disclaimer, I'm not a CPA or accountant or a tax attorney. Check out your favorite CPA or tax advisor to get details on this. But that said, if you're going to consider reverse mortgage and you're on Social Security income, you're on Medicare, no effect, you're fine. Where you can have an issue is Medicaid and SSI, because those are means tested, they're needs based, and when you get a reverse mortgage, when you get those proceeds could be considered an asset, which could upset your benefits for Medicaid or SSI, unless you take those proceeds and you use them entirely in the month that you get them. So that's the watch out for, is SSI, Medicaid. That's something we want to talk more about with the homeowner and determine if we can meet their needs in terms of getting that reverse mortgage and not upset those benefits. But otherwise, Social Security, Medicare, you're fine.
One last question, Art, and you explained at the very beginning of the show about your father and how that he used that with the $1,000 a month for 14 years, which I think is incredible. That's exactly what's supposed to happen, right? Is that the only way people can take out the proceeds, or are there different ways, or do they have to take a monthly stipend? What's the options there?
Really good question. You have a multiple number of ways you can access the funds. You can get a monthly check for lifetime. You can get a monthly check for a term, like you could say for 5 years, 10 years, 15 years. You can take a lump sum. You can take the proceeds as a line of credit.
Oh,
similar to like having a HELOC. And that, by the way, if you take all or a portion of it as a line of credit, that line of credit amount or limit grows over time. Or you can take a combination of everything I just described. We've had some borrowers say, okay, I want X amount of dollars for 5 years. I want to take a lump sum of this amount. And if I still have some left over, I want the leftover set up as a line of credit. So you have a multiple number of ways you can access those funds.
Art, you mentioned a negative AM loan and how that was set up, and it kind of gave us a bad taste in our mouth. But you also clarified, in my mind, the stories we used to hear that, when someone passed away, the spouse had to leave. But you explained why that happened. That was because they had to be taken off the deed because of their age limitation. And then because they technically were no longer owners of the property, they had to leave and vacate. That seems like that's the story we always hear, and we keep hitching our wagon to that. Is that probably what drove the idea of and gave reverse mortgage a really bad or a black eye, I should say?
It is. I think I think that's the scenario that people are still hanging on to, but it was fixed several years ago.
Yeah.
Because, that in that scenario, both the older spouse who was eligible, the younger spouse, they were initially on title to the home together. Younger spouse had to be taken off title in order to get the loan. And then it's kind of amazing. Even the government, when they designed the program, didn't think that, oh, wait a minute. When that older eligible spouse passes away and the younger spouse was taken off title, that person doesn't own the home anymore. The loan's in default. They got to scramble and get this loan paid off, and they had really no other option but to sell the home, which in most cases was a terrible outcome. And they finally figured that out, and again, fixed that several years ago.
Well, Art, first of all, thank you so much for kind of, if you will, exposing the truths and the myths about reverse mortgages. Again, we wanted to talk about this because of that fact we talked about. 1 out of 3 people living in California are at that age of 62 and older who would probably fall into this. Now, we understand 1/3 of all Californians are not homeowners that are on Medicaid, but it's impacting a lot of people. And it really, as we think about our economy, this could be something that could shift the way they live. As you explained with your father, who said, hey, he went from feeling like he could barely or not really meet his monthly needs and dip into his retirement. This could be a life change, could it not?
Well, exactly right. Of course, we've all heard the stories about how the baby boomer generation is huge and, getting older every year. And a lot of them own homes. And if they have a way to tap into some of that equity, that's going to help them live more comfortably for the remaining years. And of course, is going to be a benefit to the economy overall. So I think it's a tremendous opportunity that primarily and predominantly has mostly an upside, as long as we can help senior homeowners understand how it really works and realize it's nothing to be afraid of.
Fantastic. Well, I just want to be respectful to our people that are out there watching live. I want to thank you for joining us today. If you have any questions, please put them in. I'm going to dip out. I put Art's information on here. Please call him at 760-883-5700. If there's additional questions, as he said, it's one of those things where there's a up to $6,000 fee that can be charged by the brokers who originate the loan. Art and MortgageWorks does not do that. And so there's a savings there, and he can help walk you through that. His number is 760-883-5700. Art, thank you so much. I really appreciate your time today.
Okay. Thanks, Jeff. Take care.